I am Simon Wong, and I cover the energy sector at Gabelli Funds. This past Sunday morning, one day before a formal OPEC Plus JMMC meeting, Saudi Arabia shocked the oil market by announcing it will voluntarily cut its production by 500,000 barrels per day, beginning in May through December. This was quickly followed by the UAE, Iraq, Kuwait, Algeria, Kazakhstan, Oman, and Gabon. Russia also announced that it will extend its voluntary cut of 500,000 barrels per day from February to the end of this year. These cuts are voluntary and not a binding OPEC Plus policy, so it can be reversed at any time. Still, if these OPEC Plus nations follow through, it will cut almost 1.7 million barrels per day from production, representing just under 2% of global supply. Unlike the last cut in October 2022, this is a cut in actual production, not a cut in quota, and is coming from nations that have producing capacity. This announcement boosted Brent prices by over 6% on Monday to near $85. After the U.S. admitted publicly that it won't refill its SPR this year if oil fell to $70, as it had previously promised, we believe Saudi Arabia led these voluntary cuts to stabilize oil prices. Oil prices has been down about 15% since the beginning of this year through mid-March, before the loss of 450,000 barrels per day of supply from northern Iraq. Oil prices faced a lot of uncertainty since the beginning of this year due to fears of loss of demand from a potential global recession, high global product inventory, slower than expected reopening of China's economy, and economic uncertainties related to the recent banking crisis. While Brent oil prices are now above $80, we expect the price volatility to continue as many of the uncertainties related to demand remain. We would not be surprised if OPEC cut again later this year to support prices. We believe price volatility will particularly impact E&P companies and the amount of cash they generate and return to shareholders. Last year, Brent oil prices averaged almost $101 per barrel, 25% higher than current level. Therefore, many E&P companies will generate and return to shareholders less cash this year compared to last year. We think one of the best ways to invest in the energy sector this year is through large-cap oilfield service companies that generate a significant portion of its revenue from international and offshore markets. After years in retrenchment, many NOCs and IOCs are investing in long-cycle projects again. Unless oil prices significantly collapses, many of these projects will move forward despite the volatility in commodity prices. One oilfield service company we like is Halliburton. The company has 904 million shares outstanding, trading around $33 per share. The company has a market cap of $30 billion, including $5.6 billion of net debt. The company's total enterprise value is $35.5 billion. Halliburton is one of the largest pressure pumping companies in North America. However, we believe the company's international business is underappreciated. During the downturn, Halliburton made an investment to boost its international presence and product offerings. The company now derives about half of its business from international markets. We see the company's international business growing at least 15% this year, with substantial growth in all international markets, both onshore and offshore, and with new activity coming from the Middle East and Latin America. Halliburton's valuation remains attractive, trading at just 6.5 times 2023 EBITDA and 5.5 times 2024 EBITDA.